in May of 1975. Prior to that time, commissions on equity trades were fixed. And we worked off of I wasn't in the business in 1975, but I still had one of these tables, and I'll explain that later, where you had number of shares and stock price, and it was just a matrix. And whatever you traded, that was the share, cents per share, that was charged. It was a fixed rate. And after May of 1975, Congress deregulated that business. And all of a sudden, commission rates fell. And before, transaction costs were huge and non-competitive because everybody paid the same. And institutions started negotiating rates, and that led to more stock market volume. It led to changes in the way people paid for research, because commissions were fixed because you got execution and you got research from their research department, which would be equity analysts. But when you start taking only execution, you have to think about how you're going to pay for some of these other practices. And for those who are outside the business, they might not understand exactly what I'm talking about. For people in the business, it was a huge change. And when I started in the early 80s, we still had to calculate our commissions on trades as a discount off pre-May rates. And it really allowed retail, individual investors to start trading, and it was far less expensive for them. It democratized the business.
In my career, which was the institutional investment management business, there's no question ERISA was the biggest influence. And that came into being the 1st of January in 1975. And that transposed the pension industry significantly. It also legitimatized, if you will, investment management firms, independent investment management firms as fiduciaries. And most pension assets before ERISA were held at bank trust departments. So that led to ERISA forced sponsors to look at their pension assets and how they were managed, and that gave rise to really independent investment management firms in a significant way.
The other regulatory change is compliance, which is imposing enormous costs, and I don't simply mean monetary, I mean in terms of work on many institutions.
I would say from my standpoint as a buy-side manager and analyst, probably Sarbanes-Oxley, because of the effects it had not only on analysts, but the way that corporations convey information to members of the investment committee.
In terms of major changes in the last, let's see, 26 years since I got my CFA charter, I would say it would be the increasing globalization of the markets and information flow. A lot of markets are open 24/7 now, and of course we've had the spread of the Global Investment Performance Standards, or GIPS, which I think is a good thing.
I think more than anything else is the economic policies that have, with the Federal Reserve being much more active than it was before, and also fiscal policies of the federal government, I think, had a huge impact on the whole macro picture. And my own feeling is the macro pictures have been more important than the regulatory aspects. And one of the things that I'm pretty proud of is that we had something to do with in the FAF with encouraging them to reduce capital gains taxes. First of all, they were trying to raise capital gains taxes, and we got them not to raise capital gains taxes, and then we got them eventually to reduce them. And I think what President George Bush II did was particularly significant, reducing taxes on dividends and capital gains.
Without question, the morning of October 19th, 1987 was the most significant moment. I went to lunch and the market was down, and it really started to decline the Friday before. And I came back from lunch, and our office had glass doors from the elevator. And the trader happened to be at the receptionist desk for whatever reason. And I kind of through the mirror said, he couldn't hear me, but he could see me. Is the market up or down? And he said, it's down 25. And I said, oh, well, that's okay. And then I opened the door. He said, it's down 25% in hours. And that was after being down a lot the Friday before. So that was dramatic.
The most dramatic event that I've experienced was the 1987 crash. Up until that time, we hadn't experienced anything like that at all. And it started on a Friday and then really progressed on Monday. We didn't have the computers and the quote machines that we have today, and the tape was so late that we weren't sure if our orders were executed and at what prices. And it literally took a day or two to find out what transactions we had actually made, and, like say, at what prices. So it was alarming. It was a very scary thing to go through. But it was over fairly quickly. It lasted a few days. And then before year end, if you had stayed in before year end, you had recovered a substantial amount of the losses in your portfolio. So that kind of set the pattern for investors to buy on the dips and to buy when the market was down. And that lasted quite a while until this last event in September of 2008 that we had in the markets.
Well, the most dramatic event that I have experienced in my career is no doubt the meltdown in the fall of 2008. The crash of 1987 was painful as well, but I think it was perhaps a more reasonable correction than what we saw in the fall of 2008. I think very few people saw the magnitude of that crash like people might have anticipated the correction in 87.
Probably the most dramatic event for me, and maybe for a lot of folks, was the 9/11 attacks on New York. I certainly, like many of us on Wall Street, I think it was very personal for us that Wall Street was attacked, and many, many colleagues were lost during those attacks. So I would say in my career, there have been a lot of market movements that took place, but from a dramatic aspect, I would say the 9/11 attacks were the most significant.